Okay. Um, as accountants, we are expected to demonstrate our ability to prepare and present financial statements. However, equally important is our ability to interpret the information contained in those financial statements, and that is FS analysis or financial statements analysis. FS analysis is the process of examining a company's financial statements to evaluate the company's financial performance and financial position for decision-making purposes. External stakeholders use it to understand the overall health of an organization as well as to evaluate financial performance and business value. Internal users, on the other hand, use it as a monitoring tool for managing the finances and for other management purposes, such as using it as a basis of results on actions taken to improve the efficiency and effectiveness of operations. However, external users rely on this FS more often than the managers do. Bakit, sir? Because managers have access to more information about the company than what this FS provide. Kanino ba ang responsibility sa paggawa ng FS? The management, di ba? Okay, so the management will be the one or has the responsibility to prepare and present financial information or financial statements for the use of various stakeholders. Okay. So the following are the techniques that can be used in analyzing financial statements. So we have horizontal analysis, vertical analysis, and lastly, ratio analysis. So we're going to discuss them one by one. So first, horizontal analysis. Horizontal analysis refers to analysis of financial statements from one accounting period to another. Here, an item is compared to itself across different periods of time. So, for example, a net income in year 1, it will be compared to net income in year 2 and year 3, and so on and so forth. Horizontal analysis is effective in identifying significant changes during the year as a result of material transaction that happened during the year, such as a one-time huge transaction that affects our sales revenue for a given year. So let's say we have one-time customer that purchases in bulk. Okay, so that could lead to an spike in our net income or sales revenue. Okay? Meanwhile, pwede rin naman, let's say in 2018 you have or let's say in 2020 rather, 2020 the company experienced huge decline in net income. So using horizontal analysis, this significant change should be investigated further. So probably kaya nagkaroon ng significant decline, it's because of the pandemic. Okay? It may also identify unusual relationships between data, such as material error in the financial statements may be existing. And it also identify trends which may help the management forecast its future operations. Okay, normally we sell this amount of or normally we earn this amount of revenue. So how much should be invested in inventories? How much should be invested in accounts receivable, etc. Okay, so these trends, the reason why it is also known as the trend analysis. Okay, so horizontal analysis, it is also known as the trend analysis. So in short, horizontal analysis shows any change in the financial statement Okay, whether there is an increase or a decrease in a particular item. So to illustrate, let's answer the following problem. ABC company had net income of 2 million pesos, 2.5 million, and 4 million pesos in 2019, 2020, and 2021 respectively. Using 2019 as the base year, perform horizontal analysis. Okay, so our net income in 2019 is 2 million, 2020 and 2021, 2.5 and 4 million respectively. Okay, since 2019 is our base year, okay, to convert this into a percentage, it will be equal to 100%. Okay, because this is our basis. Now, for 2020, to convert the amount into percentage form, we have to divide the net income in 2020 by the net income in our base year. So that is 2 million. So in 2020, 2.5 million divided by 2 million, that will give us 125%. For 2021, that is 4 million, again divided by the net income in base year, which is 2 million, that will give us 200%. Now, so from these percentages, we can derive the changes that transpired in 2020 and in 2021. Okay, so changes, of course, will be either an increase or a growth in terms of income, or a decrease or a decline, okay, in terms of net income. So for 2019, of course, there will be no answer. But for 2020, there is an increase of 25%. So to determine the change, that is simply the difference between the percentages in 2020 and 2019. So 125%, sorry, 125% minus 100%, that is 25%. And for 2021, there is a 100% increase. So that's the difference between 200% and 100%. So that is for horizontal analysis. Now, next one is the vertical analysis. Vertical analysis. In vertical analysis, financial statements are converted into percentages to determine the significance of each component to a financial aggregate. Okay? In other words, it is a technique where a line item is expressed as a percentage of another item, which is called a base, within the same financial statement. Okay, for balance sheet, normally our base is the total assets. For income statement, our base is the net sales. The use of vertical analysis is effective in comparing two or more firms in the same industry despite differences in the firm's size. So imagine you are comparing Starbucks with Faron Coffee. Okay, definitely Starbucks is a bigger company, no, than the Faron. Faron ba? Okay, Faron Coffee. Anyway, so you cannot simply get their financial statements and compare the two. So because the amounts that will be provided in those two financial statements are, of course, are different, no, in terms of nature, the volume, or the level. Okay, but with the use of vertical analysis, we can do so. Okay. The other name for vertical analysis is common size analysis, because using vertical analysis, is like what I've mentioned, we can compare two different firms, no, or with different sizes. Ayan. So to illustrate, let's answer this problem. The following balance sheets of Thai Corporation and Valencia Incorporated are shown below. As you can see, the two companies have different sizes and it is not easy to compare based only on this raw information. But if we perform vertical analysis, we can make use of this information. So look at the cash. For cash, you can see 10,000 for Thai Corporation, while for Valencia there is 20,000. You cannot say that the composition of assets of Valencia in terms of cash is twice the composition of cash or total assets in terms of cash from Thai Corporation. Okay? So to perform vertical analysis, since our base in balance sheet is total assets, we're going to convert this into or set this at 100%. And the rest of the line items will be expressed as a percentage of these total assets. So that is 10,000 divided by 100,000. So that will give us 10%. So it means that the cash is 10% of the total assets. For AR, we have 20%. For inventory, that is 15%. Current assets, 45%, and then non-current assets, 55%. For Valencia Corporation, so we have the same base, which is total assets, so we set it at 100%. For the cash, that is 20 over 500. So as you can see, 4%. For AR, we have 14%, 70 over 500. Inventory, 45 divided by 500,000, that's 9%. So the total is 27%. Sorry. And then for non-current assets, 73%. Now, from these percentages, vertical analysis, we can compare these two different size firms. Okay, so as you can see, Valencia Corporation is heavily the assets of Valencia Corporation is heavily composed of non-current assets. Okay, roughly 73%. While for Thai Corporation, there's only 55%. So the current assets components, okay, total 27% only for Valencia Corporation, while for Thai Corporation, there is 45%. So that's how we can analyze the two financial statements of two different companies. Okay, so that's for vertical analysis. Okay, we can also do the same for income statement. And in the income statement, our base is the net sales. Okay. Next, we proceed to ratio analysis. For ratio analysis, it is a technique where various items in the financial statements are compared, including across financial statements. So financial ratio analysis identifies significant relationships between key financial statement items. Ratio analysis promotes intra-comparability or comparability between two accounting periods within the same entity, like horizontal analysis. So comparing the figures in 2020 to 2021 or to 2022 and so on and so forth. So ratio analysis also promotes intercomparability or comparability between two or more entities within the same industry, regardless of its size, like vertical analysis. Okay. So basically, intra and intercomparability, which are addressed by horizontal and vertical analysis respectively, are both addressed by ratio analysis. So the following are the groups of ratios in ratio analysis. So we have first the liquidity ratios. Liquidity ratios measure the ability of the company to pay its short-term obligations when they come due. Next is solvency ratios. Solvency ratios measure the ability of the company to survive in the long run. And then, activity ratios, they measure the ability of the company to efficiently use its resources. And lastly, we have profitability ratios. They measure the earning ability of the company. Although there are other ratios that may be discussed in FS analysis, we are going to focus first on these 4. Okay, so let's proceed to liquidity ratios. To appreciate this, what do we mean by liquidity? Okay, liquidity means the ability of the company to convert its assets into cash. Yan. So, cash convertibility ang ibig sabihin ng liquidity. Okay? It measures the ability of the company to pay the company's short-term obligations. So, of course, we are going to pay in cash. So, how do we get cash? That is by converting our assets into cash if they are not yet cash. Okay? So, when we say the company is liquid, the company can easily convert its assets into cash. Okay, so the following are the ratios under liquidity ratios. So we have working capital, and it is computed by deducting the current liabilities from the current assets. Next, we have the current ratio. Okay, and it is computed by dividing current assets by the current liabilities. Then we have the acid test or quick ratio. So this is quick assets divided by current liabilities. And lastly, cash ratio, which is cash plus marketable instruments divided by current liabilities. Here, the marketable instruments are considered to be in a form of cash because they can be easily converted into cash in a span of 1 to 3 days, etc. So this is similar to in financial accounting, you call this cash equivalents. Although cash equivalents are maybe converted into cash up to 90 days. Nevertheless, marketable instruments in a broader sense is included when we compute for the cash ratio. Okay, so to illustrate, let's answer the following problem. Yan, Pado Enterprise showed the following items in its balance sheet for December 31, 2020. So determine the following. Yan, working capital, current ratio, acid test ratio, and cash ratio. Okay, so working capital, this is current assets less current liabilities. Okay, so we have to determine the current assets as well as the current liabilities. So all of these, cash, marketable securities, accounts receivable, prepaid expenses, and inventories, these are all current assets. Okay, and the total current assets amounted to 40 plus 15 plus 30 plus 20 plus 25. Okay, so the total current assets amounted to 130,000. While the total current liabilities, so how much is our total current liabilities? So accounts payable is included, accrued liabilities, income tax payable, and short-term notes payable. So all of these will form part of your total current liabilities. So the total current liabilities amounted to 14 plus 11 plus 18 plus 21. Sorry, 64,000. Okay, so we have 64,000. So our working capital is the difference between the two. So that is 130 minus 64. We have 66,000. Okay. So is it a good measure of the company's liquidity? Is this working capital a good measure of company's liquidity? Actually, we have a problem with working capital alone. Okay? This working capital alone cannot be or is not effective, no, in determining whether the company is liquid or not. This is because this 66,000 is an absolute amount, or is a sorry, an amount that can pertain to the difference between, let's say, 2 million and 2,066,000. Pwede siya, di ba? Okay, if this working cap, so 2,066,000 minus 2 million, that is 66,000 also. That's your working capital. Or, based on this example, the difference between 64,000 and 130,000. So, what can you notice? In the first example, the difference of 66,000 is, of course, somehow insignificant. Okay? So, this means that our total assets is almost the same as our total liabilities, or rather total current liabilities. Now, if this one is the case, 64 and 130,000, just like in our problem, then the difference is significant. So my point here is that we cannot rely on this working capital amount alone in gauging our company's liquidity. So we're going to make use of the other ratios. Okay, so now current ratio. For current ratio, the formula is current assets divided by current liability. So we have the amounts already. 130 divided by 64. So that will give you 2.03. Okay. So what does it mean? Okay, it means that for every 1 peso of liability, we have 2 pesos in our current assets to pay for those liabilities. Okay, now, how about acid test ratio? So, acid test ratio, the difference from the current ratio is the numerator. In acid test ratio, we only have the quick assets. Okay, the current assets are, of course, are not all, these are not all quick assets or included in quick assets. So the only items that may be included in your quick assets are cash, marketable securities, and accounts receivable. So these are your quick assets. So let's compute first. 40 plus 15 plus 30. Okay, so we have 85,000. Sir, why do we exclude prepaid expenses and inventories in our quick assets? Basically, inventories, it will take a lot of time before we can convert this into cash. Okay, unlike these 3 other items. Inventories need to be sold first, and normally we sell on account, so that will become accounts receivable before we can convert them into cash upon collection. Okay, so basically, inventories are not quick enough, no, for our for these inventories to be included in our quick assets. And then prepaid expenses are the same. Prepaid expenses normally, the suppliers or our providers of these expenditures or services, they do not allow reimbursements of prepayments. Okay, so example, prepaid insurance. Okay, this prepaid insurance, once you have paid in advance, although it is not yet incurred, this will not be refunded or this will not be reimbursed. Okay, because these prepaid expenses will only be credited to your account once the corresponding services or items or goods have been delivered, services have been rendered, etc. So the point is, Prepaid expenses and inventories, although they are current assets in nature, they will still be, or they will still take time before it will still take time before we can convert them into cash, unlike the other quick assets. Okay. And then of course, lastly, the most let's answer first the acid test ratio, or the quick asset ratio. So that is 85 divided by 64. Okay, so we have 1.33. So again, what does it mean? 1.33, it means that for every peso of current liability, we can pay them using our asset 1.33 of times. Okay? So, next is the cash ratio. So, for cash ratio, as discussed in our previous slide, it is composed of the cash plus the marketable securities. So, our cash in broader sense is equivalent to 55, or is equal to 55,000. So again, why do we include marketable securities? Because marketable securities usually take 1 to 3 days for conversion of into cash. Okay, sometimes real time. Okay, so let's say the company has an investment in stocks, so it can dispose of its investments in stocks online, and then get the cash from this, and then use it to pay for the obligations of the company. Okay, so anyway, cash ratio will be 55 divided by 64. So that is 0.86. Okay, so using our cash ratio, we can say that for every peso of current liability, we can pay them at 0.86 times. Okay, so basically, the question is it good for the company to have these ratios, or what ratios do we need? Does the company need for them to be liquid? Or how do we assess these ratios to determine whether a company is liquid or not? Okay, so basically, higher liquidity ratio, the better. Okay, so we should have higher working capital, or higher current ratio, higher acid test ratio, or higher cash ratio, because it implies that the company is or has the ability to pay its short-term obligations when they come due. So, syempre, pag hindi nakabayad, magkakaroon ng problem. Okay, so magkakaroon ng bad credit standing, etc. Anyway, the problem is, lahat ng sobra, syempre, masama. Okay, so too much of a good thing is a bad thing. So, ibig sabihin, kung halimbawa, our current ratio is, example, 100 times, acid test ratio 80 times, cash ratio 50 times, our current liabilities, okay, what does it say to the company? So, number one, the company is indeed very liquid. Okay? So, they can easily pay, or they can easily convert their assets into cash to pay for these short-term obligations. However, imagine, meron kang, let's say, sari-sari store, tapos you have a petty cash of 5 million pesos. Okay? So, you really have good liquidity standing. However, the company is not efficient in managing its resources, because that 5 million can be invested into more profitable venture that will earn the company, of course, more income. So, yun ang nagiging problema. So, yun lang, laging tatandaan, lahat ng sobra, masama. Okay, so dapat level lang. And so, the last question is, Espado Enterprise. Liquid. So, anyone can answer? Sasagot ba? Based on this information, based on the ratios that we have derived from this financial or balance sheet, is Pado or is the company liquid? The answer, of course, is
Yes.
okay, may sumagot, no? Thank you for that. Pero the answer is we don't know. Hindi natin alam kung liquid ba talaga siya. Sir, bakit? Because in order for us to analyze these ratios, okay, we have to have a basis of comparison or a benchmark, 'di ba? So hindi pwedeng on its own magagamit natin siya. So, yan, dapat sabi ko nga yung 66,000 hindi pwedeng magamit, no? Current ratio, asset test ratio, cash ratio. Hindi. So we need to have some basis of comparison. So sir, ano ba yung benchmark natin or basis ng comparison? Okay, so basis of comparison is number 1, we can compare these ratios with industry average or industry standards. Okay, so average. So let's say in the food industry, they have a current ratio of 4, for example. Okay, basically, comparing it with industry average, enterprise is not that liquid. Okay? Or, we can compare it with past information or historical information. So, we can analyze whether the company is improving in terms of its liquidity. So, let's say our current ratio last time is only 1.5 times, but now it's 2. So, we are somehow improving. So, and then we can also compare it with the industry average. So, the industry average, let's say it's 3. So, we're getting there. So, yun lang. Point here is ratios alone. No? So, all of these computations that we have, it will not be useful if we are not going to compare it with other bases. Okay? So, that's it for liquidity ratios. So, let's proceed to the next set of ratios. And this is your solvency ratio. Sabi natin kanina, solvency ratios is the ability of the company to survive in the long run. Okay? So, yun nga, solvency means survivability or financial viability. So, ability to meet all long-term obligations when they come due. Okay? Actually, lahat, no? All liabilities, especially non-current liabilities when they come due. So, yun yung solvency. Of course, if the company will not be able to pay its obligations when they come due, that could lead to insolvency. Okay? So, insolvency yan. And may eventually lead to, of course, the bankruptcy. Ayan. So, yun ang problem. Okay? So, the following are the ratios under solvency ratios. Okay, so we have debt ratio, which is computed as total liabilities divided by total assets. Then, debt to equity ratio, total debt, sorry, over total equity. Then, lastly, we have times interest earned. This is earnings before interest and taxes divided by interest expense. Okay, so how do we determine if the company has a better ratio or not? For debt ratio and debt to equity ratio, of course, the lower. Okay, bakit ng lower ko? the lower, the better. Okay, because it simply means that the company has lower debts. Okay, and of course, they will be forced to pay less interest in the future. Okay, but for this times interest earned, yan, so it measures the ability. So for debt ratio and debt to equity ratio, it measures the components or how our total assets are being financed. Kasi diba there are two sources of funds. So we have debt and equity. Okay? So it's just a measure of the composition of our finances. Okay? So saan ba galing yung total assets? Is it financed by debt? Is it financed by equity? Yun. So of course, sabi ko nga, the presence of debt adds risk to the company. So it puts the company in an insolvency risk. Okay? So the lower the debt ratio and debt to equity ratio, the better. Again, for times interest earned, this measures the ability of the company to pay the interest expense. This is of course come from the debt that we have. Yan. So this is your payment for the debt or liabilities. So for this one, times interest earned, okay, the higher the better. Yan naman. Okay, because the numerator is your earnings before interest and taxes. So if we have higher times interest earned, that pertains to the number of times that we can pay for the interest expense. Anyway, to understand this better, so let's solve the following problem. Ayan. Palma Oil Corporation processes palm oils. Sorry. And the following information pertains to its financial position as of December 3rd. Muna ako. Sorry. Hindi naman to COVID, no? So, okay, mag-alala. Ayan. Anyway, Palma also showed the following income statement for the year just ended. Okay. So, determine the following ratio. Debt to equity, and times interest earned. Okay, so for debt ratio, what is the formula for debt ratio again? Total liabilities divided by total assets. Okay, so for this one, our total liabilities totaled 70,000. Okay, so 70,000. So total liability 70. So if our total assets amounted to 140, the debt ratio is 70 over 140,000. So ilan yan? So 70 divided by 140. So that's 50 or 0.5. Okay? So what does it mean? It means that our assets is 50% financed by debt. Okay, so 50% financed by debt. Or for every peso of asset, it is financed, or 50 cents is financed by debt. And therefore, of course, the other or the remaining 50 cents is provided by the equity. Okay, so this is your debt ratio. Now, for debt to equity ratio, so your debt is 70. Your equity is 70,000. So we have 1.0. So what does it mean? It means for every peso of asset, the composition of capital, the invested capital is partially financed by debt and equity. Actually, they have the same concept. So, for... so, wait lang. Pupos ko lang. Inom lang ako tubig. Saglit lang. Saglit lang. Pause lang natin. Ayan. So, saan na tayo? Anyway, yun. So, for debt ratio and debt to equity ratio, so both of them tell you the same thing. Okay? So, it pertains to the composition of the capital. So, debt or equity. For times interest earned, the formula is earnings before interest and tax, or EBIT, divided by interest expense. Okay, so our earnings before interest and taxes will be your net operating income, which is 15,000. And interest expense amounting to 6,000 pesos. Okay. So, this is 15,000 divided by 6,000. So, 2.5. Yeah. So, sorry. Bakit may K? 2.5x. Yeah. So, what does it mean? How do we interpret this tie ratio or times interest earned? Okay, so from our income, we can pay the interest expense 2.5 times over. Yun ang ibig sabihin. Okay? So, again, we cannot say that the company is solvent or not. No? So, we have to compare it with industry average or the historical information. Anyway, my question would be, if the company or if the use of debt endangers the company or puts the company at risk of insolvency, why still use debt? Bakit may mga nangungutang pa din, di ba? Kung halimbawa sa tingin natin na, yun nga, tumataas yung credit risk ng company or tumataas yung insolvency risk ng company. So, bakit? Okay, that is because of the concept of leverage. Yan. Because debt magnifies the upside. Okay. From the word lever, di ba? Ano yung lever? Alam niyo yung lever? Okay, di ba ito yung sa simple machine, di ba? Okay. Without the simple machine, parang yung ang example ata nito, no? If I'm not mistaken, yung sa may bato, may malaking bato, hindi mo siya matulak or hindi mo ma-move yung malaking bato. Okay, using your bare hands. Okay, but with the use of a simple machine, same amount of effort can produce a greater impact. Yun ang ginagawa ng debt. Na ma-magnify niya yung income, yung outcome, no? Kung ano man yung ginagawa natin. So, katulad nito, halimbawa, sige, example, meron kang business, so ABC Corporation. Okay, so ABC Corporation, unfortunately, you can only finance 25% of the operations. So, hanggang dyan lang kaya mong i-finance. Okay? So, you have two options. It's either maghanap ka ng partners. So, equity. Di ba? Dalawa yan. Maghanap ka ng kasosyo. Yan. To finance the remaining 75%. Or, pwede naman, mangutang ka na lang. Di ba? So, debt. Yan. 75%. Pwede yung mangutang ka. Or, hanap ka ng partners or kasosyo. So, halimbawa, ito. Yung company, sa ABC company, yung tinayo mo, ito yung option 1. Kumita yung company in the future. Ano mangyayari? Okay, so the income, of course, will be distributed. No? 25% lang mapupunta sa'yo, 75% doon sa kasosyo mo or sa partners mo. Okay? While, if you use debt, Okay? To finance your 75% or to finance the 75% of operations, ano mangyayari? All you have to do is to pay the interest expense for this debt. Okay? And the rest, sa'yo na mapupunta. Okay? So the remaining, after interest, after payment of interest, sa'yo mapupunta lahat yun. Okay? So sabi nga natin, because of the presence of debt, the returns are increased or magnified. Diba? Parang same yung concept, no? So, gumagamit ng debt kahit risky dahil mas malaki yung return. Diba? Sabi nila, the higher the risk, the higher the returns. So, yun ang concept, no? So, sir, ano dapat ang ideal? Okay? In summary, the level of debt shouldn't be too high to the point that it causes insolvency. Baka hindi na kayang bayaran ng company. Okay? However, the level of debt shouldn't be too low to the point that it misses out the benefit of leverage. So, wag naman yung masyadong mababa. O, hindi ka nga magiging insolvent dahil may mga pambayad ka. Okay? Dahil marami ka, puro equity, no? Konti lang yung debt. However, the returns are, of course, are lesser. Okay? Compared kung meron kang debt. So, that is your solvency ratios. Next, we have the activity ratios. So, sabi natin kanina, activity ratios, it measures the company's ability to efficiently utilize its resources. Ano ibig sabihin ng activity, no? So, pwedeng from the word active, di ba? So, gaano ka-active? Gusto natin, all the investments, no? All the investments of the company in, for example, in the current assets, such as inventories or accounts receivable, gusto natin, mabilis ang palitan or mabilis ang ikot. Okay? So, ibig sabihin, yung inventories, mas maraming turnover. Okay? So, mas maraming beses siya nabebenta, for example. So, yun ibig sabihin ng active, no? So, in this sense, activity means efficiency or utilization. Ayan. So, sabihin natin, no? It measures the ability of the company to efficiently utilize its resources. So, from the first two ratios that we are going to discuss, we are going to assign, no, sales as our activity. Okay, so from these assets, from using these assets, how much sales are generated. Yan. So, yun yung tinutukoy sa activity ratio. So, first, ba't may sagot? Okay, burahin natin. Yan. So, ito yung problem. Lovely Corporation has the following financial statements presented in its annual report. Tingnan natin kung ano yung yan. So, ito yung ratios. So, first, we have total assets turnover. Okay. It is computed by dividing sales revenue by average total assets and fixed assets turnover, sales revenue divided by average fixed assets. Okay, so bakit kailangan i-average, no? Okay, in activity ratios, income statement accounts as well as balance sheet accounts are combined to determine or to derive these ratios, no? Kaya lang, 'di ba, for balance sheet, it depicts, no, or it pertains to financial statements at certain point in time. Diba? Sinasabi natin, as of the year ended December 31, 2020. So, ang tinutukoy lang doon, yung information on December 31, 2020. Whereas, for income statement, ito naman ang tinutukoy dito ay period of time. Diba? So, halimbawa, pag nag-report, for the year just ended December 31, 20. Ang tinutukoy doon, from January 1 to December 31, how much has been generated, how much sales has been generated, or how much net income has been earned. So, ang tinutukoy doon, for the entire period. Pero pag balance sheet, so halimbawa, binigyan ka December 31. December 31, eto lang yun. Okay? So, syempre, last year, nag-report din yan. So, meron kang last year, December 31 last year. So, another point in time. Or, di ba, same lang din siya January 1. Okay, so, of course, the information that will be used in ratios will be, or rather, the ratios, the results that we could get from this information will be distorted. Okay? So, to at least, no, cure that defect in our ratios, we determine the average of the balance sheet items. Okay? To make it a representative of a period in relation to the income statement item. Okay? So, how do we get the average? Okay? So, we simply add the beginning and ending, okay, of the items, particular items, and then divide it by 2. So, simple average. And so, that's the reason why for total assets, average total assets. For fixed assets, we use the average fixed assets. Okay, so that's total assets turnover and fixed assets turnover. So, how much activity was made for every peso of resource in the company. Yun ang sinasagot ng activity ratio. So, let's go back to the problem. Ayan. So, for total assets turnover, again, this is sales revenue divided by average total assets. Okay, so our sales revenue amounted to 191,250. Okay, then divided by the average total assets. So your total assets in 2020, 120,000. In 2019, 140,000. So total of 260 divided by 2. So the average is 130,000. Okay, so divided by 130,000. So what will be your answer? Check natin. 191,250 divided by 130,000. 1.47. Okay, so how do we interpret this? 1.47. So it means for every peso of total asset that we invested, it generates 1.47 pesos of sales. Yun ang ibig sabihin. Okay? Now, for fixed assets turnover, so almost the same, no? Denominator lang naman ang nagbago. So, sales revenue divided by average fixed assets. Okay, so fixed assets is pertain to non-current assets. So, in this case, PPE only. So, 191,250 divided by 84 plus 105 divided by 2. So, 84 plus 105 divided by 2. So, we have 94.5. And then we get the turnover ratio. 191,250 divided by 94,500. So, this is 2.02. Okay, so 2.02. Okay, so same interpretation for every peso of fixed asset invested, it generates 2 pesos and 2 cents of sales. So that's it for total assets and fixed assets turnover. Aside from these two ratios, okay, meron pa tayo, no? Hindi lang yan. Yan. We have other activity ratios. So we have, yan, for operations. Inventory turnover, which is calculated by dividing cost of goods sold by average inventory. So same, balance sheet item and income statement item. AR turnover, credit sales revenue divided by average accounts receivable. And then accounts payable turnover, credit purchases divided by average accounts payable. So, pwede natin i-solve, no? So, balik tayo dun sa may isa dito. Alam ko na. Dito na lang. Ayan. So, same lang to, no? Ayan yung kanina. Okay, so we're done with number 1 and number 2. So, dito na tayo, AR, inventory, and AP turnover. Okay. So, how do we compute for inventory turnover again? Okay, ang tawag ko dito, ayan, inventory turnover. So, inventory turnover, based on the formula, the numerator is, what's your numerator? Cost of goods sold. Tama, okay? Okay, so cost of goods sold. Ano nangyari? Anyway, cost of goods. And cost of goods sold divided by average inventory. So, okay lang. So, cost of goods sold, average inventory. Yeah. Okay, so how much is your cost of goods sold? So, cost of goods sold is 153,000. And your average inventory amounted to, so average between these two, so 14 plus 10 divided by 2. So that is 12,000. Okay, so how much is what is your inventory turnover divided by 12,000? So that is 12.75. Okay, so lagyan natin here, 12.75. Next, for AR turnover, so the formula is credit sales divided by average AR. Okay, so credit sales, sir, wala nakalagay kung credit to or cash. So normally we sell on account. Okay, so if it's not stated, then we are going to assume that all of these sales revenue are on account. Okay, so this is 191 250 divided by average AR. So average AR, so since same lang, 10,000. So what is your accounts receivable turnover? So 191 250 divided by 10,000. So we have 19.13. Okay, so this is your accounts receivable turnover. Lastly, we have accounts payable turnover. So this is credit purchases divided by average accounts payable. So how do we determine the credit purchases? In the income statement, we are provided with cost of goods sold only. Okay. Diba we have a formula to compute for the cost of goods sold. Paano yun? How do we compute for cost of goods sold? Diba, beginning inventory plus purchases. Okay? That is your total goods available for sale. Diba? So, compute it directly. So, minus ending inventory. Okay, that is your cost of goods sold. So, we are looking for the purchases. Pwede na natin ma-derive. So, we have inventory of 10,000 beginning. So, this is 10 in thousands. And in thousand. So, inventory ending 14. So, minus. And then, your cost of goods sold is 153,000. So, how much is the purchases during the year? So, that is 10 minus 14 minus 153. So, that is 157,000. Okay. The problem does not state whether these purchases are on account or for cash. So again, if we normally sell on account, we normally purchase on account also. Okay, so we are going to assume that the entire 157,000 are credit purchases. So this is 157,000. Now, for average accounts payable, so that's 21,000 plus 23,000 divided by 2, that will give us 22,000. So your accounts payable turnover is equal to 7.14. Okay, so this is 7.14 x. Okay, so now, how do we interpret this data or this ratio rather? Okay, for inventory turnover, 12.75x or 12.75 times. It means that for a given year, the inventories are sold 12.75 times. Yan. So, in a given year, so in 1 year, our inventories are sold for 12.75 times. What about ARTO or accounts receivable turnover? It means that our accounts receivable has been collected 19.13 times in a given year. Yun ang ibig sabihin. And then lastly, for accounts payable, the 7.14x, it means that we have paid for our accounts payable 7.14 times in 1 year. So, 7 beses tayo nagbayad na accounts payable. Yun. Okay, so we have solved for inventory turnover, AR turnover, and accounts payable turnover. Alternatively, instead of the number of times that these items are turned over in a given year, we can solve for the number of days these items are outstanding in a given period. So, pwede nating isolve yung days inventory. So, how many days it take for our inventory to be sold? Ayun. So, that is your days inventory and it can be computed by dividing average inventory over daily cost of goods sold. And then for accounts receivable, so we have days in AR or accounts receivable. Sometimes it is also known as, or it is also called as DSO. day sales outstanding. Yan. Okay, and it is computed by dividing the average account receivable over daily credit sales. And lastly, days in AP. So, average accounts payable, daily credit sales. And so, ayan ang next natin gagawin. Okay, so let's compute for the DSI. Okay, so DSI again is average inventory divided by ito, daily credit sales. Okay, so average inventory, we have already computed for this amount, and this is 12,000. Next, how do we compute for the daily credit sales? Of course, we're going to base our computation on the total sales revenue or total credit sales revenue for 1 year. Okay, so 191,250. And then, since we are computing for the total, sir, what do we assume? 360 or 365 days. Siyempre, kinukuha natin daily credit sales. So, how many days are in a given year? So, let's assume that there are 360 days in 1 year. Although, for examination purposes, it depends, no? Kung ano yung bigay sa instructions. But for this discussion, let's assume 360 days. So, 191,250, that's your daily credit sales. That's your...
Sir?
Yes.
Sir, excuse me po. Yung sa formula po, di ba po, sir, daily COGS po, hindi po
Daily...
credit sales.
Sorry. Thank you for
Okay,
that. Very good. Yes. Okay. So, thank you for that. Oo nga, no? Nalito ako. So, this is your daily COGS. Sa DSO yon or sa accounts receivable. Thank you for that. Very good. So, this is daily cost of goods sold. Okay, so for daily cost of goods sold, that is 153,000 divided by 360. Okay. So, this is 425. So, this is your daily cost of goods sold. So, our day sales or days inventory is 12,000 divided by 425. Okay, so we have 28.24 days. Tama? Okay, 28.24 days. Next, okay, for DSO, the formula is average AR divided by daily credit sales. Okay. So we have the information about average AR, and this is 10,000. What about daily credit sales? So again, we're going to assume that this entire sales revenue is credit or on account. Okay. So divided by 360 again. So we have 531.25. So how much is your day sales outstanding? So 10,000 divided by 531.25. So this is 18.82. Okay, days. Now, last days in accounts payable. So this is average accounts payable divided by daily credit purchases. Okay, so average accounts payable is 22,000 divided by, okay, so daily credit purchases 157,000 divided by 22,000. 157,000 divided by 360. Okay, so 436.11. So our days in AP is 22,000 divided by 436.11. Okay, so we have 50.44 days. Yeah. So these are your answers. Okay, so how do we interpret this? Okay, so for day sales inventory or days inventory, it takes 28.24 days before the said inventory is sold to customers. Okay, so 28 days bago mabenta sa customer. Yun ang ibig sabihin, no? And then for DSO, or days in accounts receivable or days accounts receivable, it takes 18.82 days before those accounts receivable are collected or converted into cash. Yun ang day sales outstanding. And then lastly, days in accounts payable, it takes 52.44 days before we pay the credit purchases. Okay, so yun ang ibig sabihin yung interpretation. So again, for turnover, 12.75 times nabenta yung inventories. Okay, pero sa days, it takes 28 days bago siya mabenta. Actually, pag minultiply mo tong dalawa, pati yan, dapat ang lalabas ay 360 days. Ilang beses natin binenta yung inventories? 12.75 times. Ilang araw ang tinatagal bago natin mabenta yung inventories? Sabi dito, 28.24. So roughly 360. So same yan din sa iba, no? Same din yan of course dun sa ARTO, DSO, APTO, and days in accounts payable. Okay, ito lang, no? For activity ito sa current assets summary, no? So for current assets, we would want to move things quickly. Okay? And therefore, for turnover, gusto natin mas maraming turnover. So gusto natin dito higher. Ay, ano ba yan nangyayari? Okay, gusto natin dito higher. Ayan. Pero sa days inventory and days, gusto natin syempre it takes less day. Okay, less days for us to sell our inventories and then for us to collect accounts receivable or convert them into cash. So nakita nyo, baligtad sila. But for accounts payable, we would want to have a lower turnover for accounts payable. Gusto natin ilang beses lang tayo magbayad in a given year. And of course, we would want our accounts payable to be outstanding for more days. Ayan. So ayan ang activity ratios. Aside from this, no, meron pa tayong tinatawag na operating cycle. Ayan. And conversion cycle. So, ayan yung computation. So, for operating cycle, yan, that is the sum of day sales inventory and day sales outstanding. Okay? Pero for cash conversion, sige, ito, solve muna natin. Yung kanina, ayan. So, going back, ang ating operating cycle is the sum of DSI and DSO. So, 28.24 plus 18.82. So, ang total is 47.06. Ano ibig sabihin yan? Okay, ganito, no? It takes 47 days for us to purchase inventory, sell them to customers, and then collect the accounts receivable. So, 47 days. Actually, class, ito yung DSI. Ito naman class yung DSO. Ayan. So, if this is 28, ito naman ay 18.82. So, pwede mong i-add. Ang total will be 47.06. That is your operating cycle. So, di ba, narinig niyo sa financial accounting. Yeah? So, in determining whether an asset or liability is current or not, current or non-current, di ba, we refer to normal operating cycle. Okay. So, this is how we compute for the operating cycle. Now, how do we compute for cash conversion cycles? In some cases, we would need, for planning purposes, we would need the information for our cash requirement. Diba? Magkano ba yung kakailanganin nating cash? Kasi our cash, of course, will be invested into inventories because we're going to purchase them and then pay them, of course, before we can sell and collect them. Okay? And of course, eventually, conversion into cash. So, for cash conversion cycle, we are not going to start in the purchase of inventory. Okay? So, hindi dito sa purchase of inventory. Okay? But rather, dun sa payment. Kasi cash na yung pinag-uusapan. So, from payment of purchases or accounts payable to collection of AR. So, ito yung tinutukoy na cash conversion cycle. In other words, yun nga, based dito sa atin, no? Ayan. Ayan. Ito negative. So, ilan yan? 47.06. 47.06 less 50.44. Okay, so we have 3.38 days. So, nagkataon na negative. Ano ibig sabihin yan? How do we interpret this information? It means that we have probably we don't need cash. Okay, we don't need additional cash because we can convert our assets in 47 days and we need to pay our obligation in 50 days. Diba? So, may available ka na before ka magbayad. So, normally, positive naman tong cash conversion, no? Nagkataon lang dito sa example natin na naging negative siya. Okay, so, if naging positive yan, let's say 5 days, so it means we would need 5 days worth of cash for the payment of accounts payable. Ayun yun. Okay? So, that's it for activity ratios. Ayan. So, nasagot naman natin lahat. Okay?